Hey everybody, welcome to my video here. I want to talk today about the new OBBBA, the One Big Beautiful Bill Act versus the Tax Cut and Jobs Act. So it's a little bit late in the day, it's the end of the workday, but I figured I'll just come on and chat with you live because it seems like Facebook likes to push things a little further if I do a live video. So I'm going to do all this live with you, and I prepared a case study for you to check out, and it may relate to your situation or it may not. But if you are wondering how this new One Big Beautiful Bill Act could impact you from the senior bonus deduction perspective, I'm going to break this down and explain this to you with a comparison. This may not be your exact situation, but it could be similar, and maybe you will find it useful. So I prepared a comparison here. Okay, so we're going to talk through this comparison, and we're going to go a little further into how this whole thing works. Okay, so what I have here for you is two scenarios. On the left side here, we're calling this scenario one. Scenario one is the current, it's the previous now, for the Tax Cut and Jobs Act, how things may have went this year for you filing taxes in this situation, versus on the right here, scenario two, we're calling this the OBBBA, which is really just a current law which was signed on 7/4/2025. Okay, so I have to let you know none of this is individualized tax, investments, or personal financial advice of any kind, but I thought this was really interesting. I've been playing with these scenarios and just seeing what comes up. I have a high earning client that I was looking at today, and it looks like she may save about $10,000 in taxes from this, but she's working, okay? So she has a big income. This scenario is prepared for somewhat of I don't want to call it a normal retiree, but somewhat of an average retiree, maybe a little bit someone on the higher side who might have a good amount of income coming out of their IRA. So this particular person is a single tax filer. They're 66 years old. And what we're going to look at here is a lot of similarities and then some differences between the two scenarios, okay? So if you have questions of this along the way and you're watching this live or you're watching this later, go ahead and just drop those in the chat and in the comments there, and I'll come back and I'll do my best to answer those as best as I can. So where we want to start first is the similarities, okay? So these two scenarios have the same amount of income, okay? The IRA distributions on both are $45,000 for the year, and this is for 2025, okay? The gross Social Security is $30,000 on both. And you may be aware, but not 100% of Social Security is taxable, right? So the taxable amount of this Social Security is $25,500, which means they are at the 85% threshold for the taxable Social Security. So all that's the same. So same income sources, right? So same income sources. Total income here, as you can see, $70,500 and $70,500, okay? So the first thing that's changed with the OBBBA, I'm not even sure, I want to say this in a faster way and an easier way to say it, but the One Big Beautiful Bill Act, it's just a long thing. So I'm going to call it OBBBA for now. In the new act, the standard deduction for someone that's 66 has gone from $17,000, which is what it would have been this year, up to $17,750. Okay, so you're essentially getting a bigger standard deduction there. And then you're getting what it says here is the enhanced senior deduction of another $6,000. So if people are talking about no tax on Social Security, and I've even been talking about that too, but the more I look into this, what this really is really just a larger standard deduction for anybody that is age 65 or older, okay? That's really what it is. So each person on the tax return that is 65 or older is going to get an additional $6,000 of standard deduction, basically, right? So that's really just how it works. And for some people, they're estimating it's going to go from 66% to 90% of people aren't going to pay tax on their Social Security. But even if you're not taking Social Security, this is still potentially going to benefit you. If you are taking Social Security, it can still benefit you. But I thought this was really interesting. I just plugged in some numbers and it kind of came out this way, and I thought it was interesting, so I'm going to share with you. Okay? So with these numbers, okay, we have the total income, $70,500, $70,500. That's the same. But now we come down here to the taxable income. So this was literally before, like 3 or 4 days ago. Okay, before this new act was signed, the OBBBA was signed. The taxable income for this person was going to be $53,500 for 2025. Now, with the increased deductions between the increased standard and the enhanced senior deduction, also called a senior bonus deduction, they're going to get an additional $6,000 $750 off of the top of their taxable income. So now their taxable income goes from $53,500 down to $46,750. Okay, so hopefully you're with me so far. So what that means is, because of the deduction, this person previously was in the marginal bracket of 22%. We'll go through this in a minute here on the tax report. But now they're down in the 12% bracket. So they're now down in the 12% bracket here because of this extra deduction. So what you're seeing here is their effective rate went down by 1%, but their total tax went from $66.84 down to $53.72, and that's for federal. So they're saving $1,312 in this particular situation. So this is a pretty good deduction, right? Pretty good deduction on there. So hopefully this makes sense. And now we're going to switch over here to our reports, okay? And we're going to go a little deeper in this. I want to help you understand a couple things because I think a lot of people don't understand how Social Security taxation works. So now what we're looking at here, this is the same situation we saw that was on the left side. Okay, so this is tax year 2025 TCJA. That's what you're seeing here. And so this person, again, as we talked about, $70,500 of income. The standard deduction was $17,000. Their taxable income was $53,500. And their total tax was going to be $66.84. Okay, and this was prior. So on this side here, we're going to see total Social Security here, $30,000, and then the taxable is $25,500. So remember, that's all going to be the same as far as that is concerned. The big difference is going to be the marginal bracket here, and the average bracket will change a little bit. So let's come down here. And this chart here on the right, I really like this chart. It's like a bar chart on the right side here. And you can see here how much income and how much tax will be paid in each of these brackets, okay? So on the left side here, we have the 10% bracket. That's from 0 to $11,925. That's after your standard deduction. So the ordinary income between those two brackets is $11,925. It's a 10% marginal rate, and then that means the tax on that's going to be $1,193. So if you weren't aware, the tax brackets start with the standard deduction. That's essentially your 0% tax bracket. And then from there, we're going to go to the 10%. So anything in this 10% bracket, that amount in between those two numbers is taxed at 10%. So that's $1,193. Okay. Then here in the 12% bracket, the amount here goes from $11,925 to $48,485. Okay, so there's $36,550 between these two brackets, and the tax owed is 12% of $36,550. Right, so you're in the 12% bracket. Well, currently with the same income in 2025, just a few days ago, this person was over the $48,475 lower bracket of the 22% marginal bracket. And they're in now the 22% by about $5,025. So on the $5,025 that they're in the 22% marginal bracket, they're going to owe $1,106 of taxes on that. Okay. So if we come over here, we can see it's a little more visual. The first $11,925, their tax rate is 10%. The tax they're going to owe is $1,193. Then the next section here, which is a 12% bracket, is from $11,925 to $48,475. The amount of income between those two brackets is $36,550, and the tax owed on that would be $43,886. And up here, the amount above the 12% bracket, so in the 22, as you can see here, the rate says 22. The threshold is $48,475, and they're in that 22% bracket by $5,025. Okay, so now on that money, the tax is going to be $1,106, okay? That's the left side scenario. That was the current, the Tax Cut and Jobs Act brackets, okay? So now let's come over here. This is our scenario 2. This is our OBBA, okay? So what you can see here is the total income is the same, but here the standard deduction has increased. So, and you can see the taxable income has decreased and the total tax has decreased. So how does that work? So prior, we're in the 22% bracket. Now we're in the 12. So let's look at that here. Now we still have our 10% bracket filled, but here we're in the 12% bracket because we have an additional $34,825 in this bracket, which gives us a tax of $41,779. Let's look at our visual here. Okay. So 10% bracket's full, but because we're getting an additional $6,750 off of our income this year, we are now below this little dotted line, which means we're still in the 12% bracket. So even though this person is paying, they're both paying tax on their Social Security, right? We're coming up here. Both of their Social Security is taxable. They're paying, there's $25,000 of the Social Security that is taxable. They're still saving tax on their overall tax bill. The overall tax savings was $1,312 between these two, right? Because we're going from the 22% bracket down to the 12% bracket. And the total tax savings here is $1312 on this particular person. So hopefully this is all making sense. One other thing I want to show you here is how Social Security taxes are calculated, because I think a lot of people don't know this. And the way I like to explain it when I'm working with clients is, prior to retirement, you only had to worry about two tax brackets really, and that's your marginal tax bracket and your capital gains tax bracket, which are actually pretty similar, okay? But when you go into retirement, especially when you hit 65, you now have to worry about, I should say 65 and on Social Security. When you're 65 and on Social Security, you have to worry about four tax brackets, okay? You have your marginal and your capital gains, and now you have a new one that's called provisional income, right? So your provisional income bracket is essentially what determines if your Social Security is going to be taxable. So for a single filer, if you have less than $25,000 of provisional income, which is a different calculation, I'm going to cover this with you in just a minute, none of your Social Security will be taxable. So when they say 90% of people are not going to pay any tax on Social Security, that means your provisional income is going to be less than $25,000 for single and less than $32,000 for joint. If you are above $25,000 provisional income but less than $34,000, then a portion of your Social Security will be taxable at 50%. 50% of it will be income to you. And then anything more than $34,000, then 85% of your Social Security becomes taxable. So in this case, this person has $60,000 of combined income. Okay. So how does the provisional income calculation work? How it works is you take your AGI, which is $45,000, and in this case, all they had was the IRA distribution, right? That's their AGI. Then you take $15,000. I should say AGI not including Social Security benefits, right? So AGI not including Social Security benefits. And if you have any non-taxable interest, so that could be like municipal bond interest, that does get counted in here. Okay, so that this case we don't have any. And then we take $15,000 from here because it's 50% of Social Security benefits. So AGI not including Social Security plus 50% of any Social Security benefits plus any non-taxable interest, you get that total combined income, and that's your provisional income of $60,000. So whatever this provisional income number is, if it's above one of these thresholds here, then your Social Security is going to be taxable. So I hope that makes sense. I know it's a little bit confusing, but in this case, 85% is taxable. And that is the third tax bracket you need to worry about if you are in retirement age. The last one is your IRMA brackets, which is for Medicare, and we'll talk about that in another video. But going back to our example here of the comparison, I want to go back to this. In this case, this person can have $70,500 of total income coming in, and now after all the deductions, they're only going to pay tax on $46,750. So their tax owed this year federally will be $5,372, and that brings them down from a 22% bracket to a 12% bracket and puts $1,312 in their pocket for this year. So that's not insignificant. That's a couple of great plane tickets to go on a trip. Doesn't mean their Social Security is not taxable. It just means that they're going to save taxes. So it really is more of a senior bonus than it really is a no tax on Social Security. So I'm going to see if there's any questions here, but I think this is what I wanted to cover mostly with you. So let me check for any questions that have come in. And if you have any questions, go ahead and put those in the chat now, and I'll do my best to answer those. So let's see what we got here. Okay, so good question. So Patty asks, what happens to those who make over $75,000? Patty, you're right. It is phased out, right? So it is phased out. So that is something, again, if you give me a specific number, Patty, I can definitely take a look at that. But let's pull up this scenario. Let's switch back over and pull up this scenario and see what that could possibly look like. Let's go back over here in just a moment. This is why I like doing these live, because these are good questions. So good question, Patty. So Patty asks, what happens if you go over $75,000? Okay. So let's bring this back. So now this person here, their income is $70,500 as a single filer, right? So let's say they take out another $10,000 of IRA distribution. Okay, now they're at $55,000. So now you're going to see here, you start to lose some of this deduction. But prior it was $6,000, now it's $5,670 for this, right? So you're going to be able to go up quite a bit here. Let's go up to $100,000. Let's see where this puts us at. So total income here will be $125,000, and even at $125,000, we still it looks like we have about $2,970 of our senior deduction left over, right? So what's going to happen, Patty, is it gets phased out, basically, right? It gets phased out at higher amounts. So for anybody that is currently dealing with this, isn't sure what to do, or just want someone else to look at your situation, these are things that I'd be happy to discuss with you because I do think there's going to be a lot of things in here that might be important. Let me put on a different one there. If you're somebody who is looking to just kind of get a holistic view on your tax picture, you want someone to look at it for you, you want to help you understand where you're at, a big thing here could be Roth conversions, right? So as Patty brought up, as you go over 75,000, you're going to start to lose some of this senior deduction. But it still could make sense to be thinking about a Roth conversion for this year because you don't want to necessarily waste some of the lower brackets, especially if you're going to be in a higher bracket later when you have your required distributions kicking in, which are for most people going to be after 75 for the most part, right? So hopefully you found this useful. My name is Jason Hamilton. I'm a certified financial planner. My firm is Keep It Simple Financial Planning. And so if you did find this useful, if you have any questions, or if you would like to run your scenario together, go ahead and book a call. If we're going to run your scenario, I will require your most recent tax return and all your information to be able to get the income and everything that I need to run the scenario with you. But I'm happy to do that with you at no cost and help you understand where you're currently sitting. And if it makes sense for you to consider either accelerating income, reducing income, maybe doing a Roth conversion, not doing a Roth conversion. These are all big questions that are probably on your mind with this new tax plan. And I can tell you now we're bringing everything into our tool here that I just showed you, and we can do a comparison of where you're currently at versus where you might be in the future. So hopefully you found that interesting. I just wanted to share that with you folks. And if you're watching this later, thank you so much for watching. I appreciate it. And we'll continue to do more of these scenarios to help you understand exactly what's going on with this new tax plan, because I do think there's a lot of savings to be had. I think for most people that are kind of in my group here following this page, you're probably going to see a benefit, but I do think you want to be strategic with the benefits and looking at accelerating income versus maybe having a bigger required distribution later, because we only have this deduction for about 4 years, 2025 to 2028. So it does start this year. So this year is the year to look at your tax plan. You don't want to wait another year. So once again, folks, my name is Jason Hamilton. I look forward to seeing you on the next one, and have a great evening. Thank you for watching.